we're getting bad advice from attorneys around how to beat the tax code. And your podcast is about tax strategies. And so, of course, you can have a legal, good, correct tax strategy, and you can also have a tax strategy that just flat out won't work.
So now let's dive right into our topic, cannabis capital gains tax deferral. But even before we go there, more so just the cannabis industry and kind of demystifying the tax behind it. So Andrew, what's the biggest secret or biggest thing to overcome when it comes to understanding the cannabis industry and the accounting and the tax and the systems behind it?
Yeah, so it's a very tricky industry. I was in oil and gas for 10 years, and it's also a very tricky industry, but almost the opposite, where you have the big four. It's been around for decades. You've got software, we've got gap guidance, we've got industry guides, we've got all these tools. And so it kind of goes from the top down. Cannabis went the other way, and up to even a couple of years ago, you could not find a CPA that would touch it. They're like, no way I'm getting anywhere near that. It's crazy. It's illegal. It's federally illegal, which is still true today. It's still on Schedule 1. That said, in just a few short years, we've gone from where no one would touch it. Pretty much all the big national firms are in the space at this point, except for the big four. All the small firms are in it, the medium size. And so, but still today, yeah, we don't have all that gap guidance or industry guides, et cetera. And so we kind of had to learn it from the bottom, and layered over the top of that, many of the companies in the early states like mine, Colorado, Oregon, California, were getting bad advice from attorneys around how to beat the tax code. And your podcast is about tax strategies. And so, of course, you can have a legal, good, correct tax strategy, and you can also have a tax strategy that just flat out won't work. And so these kind of strategies were pitched by a lot of attorneys, et cetera. And so a lot of the early people, like Harborside's a good case to go read. They spent 10 years in court and still lost $11 million, and no telling how much in court fees, because the IRS is winning most of the positions. The tax code in particular that affects marijuana is 280E. It's a very easy tax code to learn because it's only one sentence. If you Google IRC 280E, it's only one sentence long, and it's very simple. It says if your company traffics, whatever that means, in Schedule 1 drugs, which used to be cannabis and CBD and hemp, now it's only cannabis, CBD and hemp are off Schedule 1. But for cannabis, it says no deductions and no credits, period. So if you traffic in a Schedule 1 drug, the tax code doesn't matter to you because you don't get any deductions or credits anyway. Now, that said, 471 comes into play, which is not a deduction or a credit. It's inventory. And so whether you sell heroin or cannabis or whatever and file a tax return, you can book cost into inventory, which go to cost of goods sold, and lower your taxable income. And so first and foremost, we want to do 471, especially -11 for our farms and processing and product manufacturers, so that we can get a lot of cost into inventory correctly, and so that they will avoid some of that tax issue.
Okay, let me try to unpack that a little bit, right? And I love the way you've used the analogy of oil and gas industry, right? Where it's been around for a very long time. You have industry experts and guidelines, and it's kind of set. And of course, it's for the professionals to interpret each particular, business model and set up of businesses and entities and different things like that to apply the law. But cannabis is like the reverse order. It's like it's starting and it's moving its way up. Even the big four still don't have, let's say, aren't really working on it. It's more like the mid-sized small firms, and so it's kind of this is still new, but it's important to understand that you still have to follow the guidelines, right? The IRS has codes and has guidelines, and if you're not doing it properly, you're going to owe the tax, right? I think CPA tax attorney that I work with, he basically says it's interesting with the IRS and the law and the way it's written, that essentially it's the one thing, especially when it comes to tax, that you're guilty until proven innocent, right? Yeah. So if they show up, Andrew, maybe talk on this, and they say, hey, you owe us a tax. Prove that you don't, right? Prove that you had an expense for this, or prove that it actually, you said 2AE and 471-11. Prove that it wasn't, that it was a legitimate, thing that you were doing here, right? And if not, we owe the tax plus penalties plus interest, right? So explain that concept too to folks who may not understand that.
Yeah, and so the IRS is pretty much, I mean, I think in most industries, the IRS goes after people and they win some and they lose some. They're winning every single case. And even small mom and pop farmers, they'll get $500,000 or more. It's a very, very punitive tax. So even if you think about it this way, you're a dispensary, which we see everywhere, you it's like most retail, that Keystone markup, you buy your product, you sell it for double, so that's your gross profit. Well, basically you're paying tax on gross profit. And so running a retailer is very hard in any industry, but imagine paying tax to the IRS on gross profit, and on top of that you're paying other taxes to the state and city. And so it's very, very difficult. And so really, even if they do this correctly, they can actually on the farming side make a little bit more because they can get a lot of costs into inventory. But for much of the industry, if they do this correctly, they're more likely than not going to have a net loss and have a tax bill, and their cash flow is going to be negative. So they need to be very well capitalized. That said, it reminds me a little bit of the high tech industry. Think of things like Amazon that operated at a loss for years and years, and investors don't care because they're growing, they're building market share, brand, revenue. They know eventually the profits will come. And so cannabis CBD is really a lot like that. So if you're going to start a farm or a processing plant, you better have millions of dollars to withstand those tough times. But you can still make a killing even with net income zero or even a tax loss, because companies are valued pretty highly in this space. And you can even go look at a couple of public companies. Tilray is a great example. They're up in Canada right now, and they're starting to do some buy into the US, but they're valued, I think, at $4 or $5 billion, and they have just astronomical losses every quarter. So that's kind of where we are now. There are bills in Congress right this second in the Senate to do what they did for CBD. Literally just take it off Schedule 1 and 280E disappears. And so we'll see what
Excellent.
happens with that.
Very well said. By the way, you can learn more about Andrew Hunzicker, CPA, at dopecfo.com. Yep, it's exactly how you heard. It's dopecfo.com, DOPE, CFO.com.